Becoming a successful investor is often the goal of every individual who buys and sells stocks. Whether it be a short-term investor or a long-term investor, every investor's goal should be the same: to make the most profit possible out of an investment in the shortest amount of time. Oftentimes, the stocks that give the biggest opportunity for massive profits are growth stocks. There are several key points that investors should look at when looking at growth stocks. In this video, I will discuss the different criteria that investors should search for when looking to find the best growth stocks for successful investing, as well as strategies the wealthy use to start building massive growth portfolios with consistency and success using the simple strategies outlined in this video. Get ready, you are now entering the Academy. Investors have several strategies that they can use to make money in the stock market. One popular strategy is to buy shares of growth stocks, which are businesses that are expected to increase their profits or revenues at a faster than average pace. Companies that can do so for an extended period of time tend to be rewarded with a higher share price, enabling their investors to earn big returns through capital appreciation. Keep in mind, potential high growth companies come with both reward and risk, so it's important to know the basics of what growth investing entails, its risks, and how to minimize them before getting started with a growth investing strategy. But once you're ready, how do investors find growth stocks to invest in? There are a few methods that can be used to identify companies that are about to take off. Macro trends. Companies that are able to capitalize on a trend that takes years to play out can often see their revenue and profits grow for years on end and can generate huge returns for investors. So what macro trends are happening right now that investors can take advantage of? A few include health and wellness. Have you noticed that more Americans are starting to adopt a healthier lifestyle? This trend is unfolding in numerous ways, such as the growing popularity of yoga to the rising use of organic foods. This is a trend that looks like it is here to stay and is poised to benefit many different companies. From organic food distributors like United Natural Foods to yoga clothing makers like Lululemon Athletics, there are many ways that investors can take advantage of this trend. Another trend is the war on cash. The trend has been toward usage of debit or credit cards to pay for goods, although 85% of global transactions still take place using cash or check. But this trend will quickly reverse, going cashless, which allows for faster transactions, and the ability to earn rewards is a huge advantage to switch to plastic over time. Investing in companies that will benefit from this shift, like Visa, MasterCard, and Square, is a wise choice for the savvy investor. Another trend is the rise of online advertising. Companies are shifting their ad dollars toward online channels so they can still keep in touch with the consumers. This spending shift is creating a huge opportunity for companies that excel at reaching consumers online, such as HubSpot, The Trade Desk, and Facebook. These are huge companies with millions, if not billions of dollars in ad revenue running through their balance sheets and make for a wise addition to anyone's portfolio. Another trend is the aging population of the United States. Did you know that 10,000 Americans will turn 65 every single day between 2010 and 2029? This massive demographic shift is a strong tailwind for all companies that cater to the needs of seniors. All kinds of businesses will benefit from this trend, including assisted living property owners like Welltower and healthcare conglomerates like Johnson & Johnson. These are just a few of the macro trends to look for when trying to find the next big growth stock to invest in, if you choose to invest in a company other than those mentioned previously. Taking advantage of hedge fund giants. Wall Street fund managers usually have huge research budgets at their disposal that they use to find great businesses. Since these big money managers are required to report their holdings to the SEC every 90 days, it can be an eye-opening learning experience to pick through their recent buys and sells to see what stocks they like. While not every growth fund manager is worth following, there are several that can be great sources of growth stock ideas. Here are a few growth investors to follow. First, we have Pat Dorsey of Dorsey Asset Management. Dorsey was a director of equity research at Morningstar for more than a decade and authored 2 must-read books for growth investors: The 5 Rules for Successful Stock Investing and The Little Book That Builds Wealth. Dorsey now runs his own asset management business, and he makes concentrated bets in growth stocks that he believes will be able to compound shareholder wealth for years. Another manager is Chuck Aker from Aker Capital Management. Aker ran the FBR Focused Fund from 1997 to 2009 and produced annualized returns of more than 12% during his tenure, which was far ahead of the 4.4% return of the S&P 500 over the same time frame. Aker launched his own mutual funds in 2009. His style is to buy growth stocks that are trading for value prices, and he rarely sells. Another fund manager is Carl Icahn of Icahn Capital Management. Long-term investors in Icahn publicly traded investment vehicle, Icahn Enterprises, have enjoyed market-beating returns. Icahn's net worth has ballooned to more than $18 billion because of his knack for finding mispriced stocks. In recent years, he has become an activist investor who buys a meaningful position in a company and then shakes up its board of directors and management team in an effort to improve business. Screening for growth companies. Growth stocks can also be searched by screening for companies that meet certain criteria. While there are several stock screeners for investors to choose from, FinViz is one of the best screeners. This easy-to-use website has data on more than 7,300 companies, and investors can input a variety of parameters to help them find stocks that fit the criteria they find most useful. Here are a few traits that a growth investor can use to screen the market for growth stocks. Market cap. This metric is a quick way to measure a company's size. Make sure to screen for companies that have a market cap of at least $300 million. Since most penny stocks are worth far less than $300 million, this is an easy way to keep them off your radar. Profitability. Companies that are showing consistent profits tend to be a lot less riskier than those that are burning capital. A quick way to screen for profitability is to set the PE ratio to a positive number. This will weed out any business that have not yet produced positive net income. Sales growth. The best growth stocks are capable of growing their profits for years on end, and there's no reliable way to do that without increasing revenue too. Projected profit growth. Tracking profit growth is another metric one can use to predict how much a profit a company will make in the next several years. Sector. Some sectors are harder places for investors to make money than others. Focusing on sectors where businesses can build a lasting competitive advantage is key in picking the right growth stocks. Some of the sectors to focus on are the technology, healthcare, services, and financial sectors. The key is for investors to stick with industries that they understand and have more knowledge about. Balance sheet. While debt isn't always a bad thing, companies that carry huge amounts of debt on their balance sheet is a big red flag. Debt-to-equity ratio can be used to eliminate highly indebted companies from search results. This ratio compares the amount of total debt that a company has to its shareholder equity, which can be thought of as the net worth of the business. A good rule of thumb is to set the debt-to-equity ratio below 30%. However, the lower the number, the better. A stock screener can be used with the following criteria to find great growth stock opportunities in the market. Market cap over $300 million, based in the United States, profitable on a trailing basis, meaning the company's actual results for the last 12 months, profitable on a forward basis, meaning its estimated profits over the next 12 months, positive earnings growth over the past 5 years, sales growth of at least 10% over the past 5 years, a debt-to-equity ratio below 0.1, and expected profit growth of 15% or more. By employing the strategies mentioned in this video, growth investors can find great growth stocks that can appreciate over time, allowing one to build and begin the necessary foundation in building capital appreciation flows that will grow over time and continue to increase significantly as one's portfolio gains momentum. Through careful planning and diligent investment of capital, as well as smart money management and reinvestment of capital gains profits into one's portfolio, one can create income streams that can provide substantial income, eventually surpassing the millionaire status and beyond. Be sure to take advantage of the stock trading app Webull, which allows one to purchase growth stocks commission-free. And take advantage of getting 2 free stocks when you sign up and fund your first $100 into your account. Thank you for watching this video. If you enjoyed watching, don't forget to smash the like button. It will really help out the YouTube algorithm in bringing you more wealth creation strategy videos. And if you haven't done so already, be sure to subscribe to the 10X Academy. And don't forget to turn on the notification bell to be alerted on more passive income strategy videos. This is the 10X Academy.